Welcome to the deep dive. Today we're really digging into what feels like a fascinating tug of war in the digital asset market. If you just glance at the surface, you might see one story, but we'll dig just a little deeper. And a completely different narrative seems to unfold. It's this compelling contradiction we want to unpack. So our mission today is to cut through that noise. We're going to take the latest digital asset intelligence briefing. This one's from August 6, 2025, and really try to reveal the structural shifts that are defining the future. We'll explore why those, seemingly bearish short-term signs are clashing so sharply with what look like deeply bullish long-term fundamentals.
And that's exactly it. That's the core divergence that really matters right now. On one side, you've got the daily price moves and the short-term things like the recent ETF outflows. And, okay, that often reflects just natural profit-taking. But then on the other side, we're seeing landmark corporate adoption, significant regulatory shifts that are actually clarifying things. And these latter trends, they aren't just noise, They're fundamentally strengthening the long-term investment case. They hold, well, far greater structural significance for where this market is actually heading.
Okay, so let's unpack that. This apparent contradiction. You mentioned some cautionary signals first. What's the latest price action telling us? Is the market feeling a bit jittery?
Bitcoin is definitely in a consolidation phase right now. The CoinDesk Bitcoin Price Index, the XBX, it recently closed just over $113,600. It was a small dip, actually broke a two-day winning streak. It's been trading within a pretty defined range. You've got immediate resistance, sort of that ceiling, around $114,500 up to maybe $115,500. And then critical support, the floor, holding between $112,000 and $112,400. So this suggests, yeah, there's selling pressure when the price tries to move higher, but also very strong buying interest kicking in at those lower levels. It stops it falling further.
Like a real tug of war, then.
Exactly, in real time.
And a significant headwind, something we've definitely seen reported, are these sustained outflows from the U.S. spot Bitcoin ETFs. That certainly grabbed headlines, didn't it?
It absolutely did, yeah. On August 6th, these ETFs saw net outflows of about $196 million, which, contributed to a pretty substantial four-day total of $1.36 billion flowing out. We even saw that single-day exodus, over $800 million on August 1st. Huge number.
Wow, largest in 5 months, I think.
That's right. Now, this is a pretty clear indicator of institutional profit-taking.
Well,
You have to remember, Bitcoin had that strong 14% rally in July. So it's a completely rational, you could say disciplined move for fund managers to lock in those gains. And while it definitely creates that immediate downward pressure, contributes to the cautious feeling, it looks more like a tactical move by, let's say, one class of investors rather than a fundamental shift in the whole institutional view.
okay, so surface level, profit-taking consolidation. But you mentioned this deeper, more bullish story playing out underneath it all. What's the on-chain data showing us that contrasts with this?
Yeah, this is where it gets really fascinating. There's this strong undercurrent of holder conviction, sort of bubbling beneath those short-term ripples. So while momentum might be cooling off a bit, the broader uptrend still looks firmly intact. One of the most telling metrics, I think, is Bitcoin's on-chain velocity. It's actually fallen to a decade low.
A decade low. Wow. And velocity means how often coins are moving.
Exactly. Think of it as how often a Bitcoin changes hands, moves between wallets. Low velocity suggests people are holding onto their coins. They're not actively spending or trading them as much. This indicates a pretty profound structural shift, really. Bitcoin is increasingly seen as a long-term store of value. More coins are moving into cold storage, those highly secure offline wallets, rather than sitting on exchanges ready to be traded. It's classic hodling behavior that's HODLing, pronounced hodling, where investors are just holding firm for the long haul.
Hodling. Got it.
And we also see a net outflow of Bitcoin from exchanges overall, and a decrease in the total reserves held on exchanges, which basically means there's just less supply readily available for sale on the open market. And get this, despite a remarkable 92.4% of all circulating Bitcoin currently being in profit.
92%.
Yeah. Despite that, large-scale selling by long-term holders is surprisingly subdued compared to what we saw at previous market peaks. This supply-side tightness, it creates this potentially quite volatile setup, right? Where the price could actually move sharply higher once this temporary selling pressure from the ETFs eventually eases off.
And this idea of scarcity, it's not just the hard cap of 21 million coins, is it? It's also about how many people can realistically own a full Bitcoin. That's a powerful point.
It really is, and it raises this important question about scarcity, but also exclusivity. So public blockchain data, it shows less than 983,000 wallet addresses currently hold at least one Bitcoin.
Less than 1 million addresses.
Right. But here's the kicker. When you adjust for large entities like exchanges or big corporate treasuries that spread their holdings across maybe hundreds of wallets, the estimated number of individual people who truly own a full coin, it's probably closer to 800,000.
Only 800,000 people worldwide.
Roughly, yes. And this growing exclusivity, it isn't just about the price going up. It kind of fundamentally reshapes Bitcoin's original idea, doesn't it? Is it still the people's currency if fewer than 800,000 individuals can realistically own a whole one? This growing gap between the few individual holders and these vast corporate treasuries, it forces us to maybe reevaluate that digital gold narrative. It's becoming maybe less like digital gold for everyone and more like, I don't know, digital platinum for the few.
Interesting analogy.
And that's a really significant shift in its identity. And it's a direct result of this accelerating institutional and corporate demand we're seeing. I mean, when entities like Strategy Inc. hold a staggering 628,791 Bitcoin, they're absorbing such a huge share of that finite supply. It just makes it mathematically harder for the average investor to ever acquire a full coin.
Okay, so that scarcity picture is stark. Let's pivot to the other side of that coin then. If the short-term ETF stuff shows some profit-taking, then this next piece, the sheer sophistication of institutional adoption, that really provides the counterpoint, doesn't it? This isn't just like buying a bit, it's deep integration. What are some standout examples just from the last day or so?
Yeah, we're absolutely seeing multifaceted integration. It's not just one thing. Take Anchorage Digital. They're the first federally chartered digital asset bank in the U.S., right? Regulated. They just executed a massive $1.19 billion over-the-counter OTC purchase. That was for over 10,000 Bitcoins, all done in just 9 hours.
$1 billion in 9 hours.
Yeah, and they immediately secured it all in multi-signature cold wallets. So basically, highly secure offline storage needing multiple keys to access, like a digital Fort Knox needing several keys. This isn't just some tech firm buying Bitcoin speculatively. This is a trusted, federally regulated financial institution making a strategic billion-dollar move. It signals clear long-term conviction.
Okay, that's a big statement from Anchorage. What about beyond Bitcoin?
All right, it's diversifying too. SharpLink Gaming, they're NASDAQ listed, chaired by Joe Lubin, who co-founded Ethereum. They just acquired another 83,561 Ether for $304 million. That brings their total Ether treasury now to over $1.9 billion.
Almost $2 billion in Ether.
Exactly. And what's really interesting here is they actually earned 929 ETH, which is about $3.4 million, just from staking rewards. So this highlights that yield-generating potential that's attracting serious corporate interest to assets like Ethereum, these proof-of-stake networks where you can earn rewards just for holding and helping secure the network.
That's incredible. So companies are using their balance sheets not just to hold assets, but to actively generate revenue through crypto mechanisms like staking.
Precisely.
But I wonder, does this also raise maybe new kinds of concerns, like concentration risk? Or for a traditional company, tying their capital structure so closely to such a, volatile asset class?
That's a really valid point, and it speaks to how risk management is evolving within these firms. They're clearly weighing that volatility against the potential upside, the yield, the new financing options. Look at the UK's Smarter Web company. They already hold Bitcoin on their balance sheet. They just successfully raised $21 million, but they did it through a Bitcoin-denominated bond offering.
A Bitcoin bond.
Yeah, and this offering was fully subscribed, notably backed by a big French asset manager, Tobam. This innovative financing, it aligns their capital structure with their treasury strategy. And apparently, it resulted in about 5% less equity dilution compared to if they'd done a traditional raise.
So a calculated risk, but with clear benefits in this case.
Seems so.
Yeah.
And we've also seen Sweden's H100 group continuing to expand its Bitcoin treasury. They bought another 60.6 Bitcoins. They're actually the first public company in Sweden with a formal Bitcoin buying strategy.
And companies aren't just sticking to Bitcoin anymore, are they? We're seeing diversification.
It's exactly right. A growing trend among public companies is diversifying their crypto holdings to include assets that offer staking rewards. Solana, or SOL, is a big one here. Firms like Upexi, they do supply chain management, and even crypto miner Bitmining. They've recently made significant SOL purchases. Upexi upped its holdings to over 2 million SOL, and they reported earning an 8% yield from that, generating something like $65,000 in daily revenue just from staking.
65 grand a day from staking SOL.
It shows corporations are actively chasing these yield opportunities within crypto. It's not just about getting exposure to the price going up anymore. It really underlines how fast the traditional finance playbook is being, rewritten.
It sounds like explosive growth, really sustained growth in corporate adoption, but
Right.
there's a counterpoint from an industry leader, Michael Novogratz, right? What's his perspective on this?
Yeah, stepping back a bit, Michael Novogratz, he's the CEO of Galaxy Digital. He suggested that maybe the explosive growth phase, the initial rush of companies adding crypto to their balance sheets, might have actually peaked. He believes the market will now consolidate around the established players. The Strategy Incs., the Bitmines, the SharpLinks. They'll keep growing their holdings, sure. But Novogratz sees it shifting more towards, say, recurring revenue from existing clients rather than a continuous flood of brand new companies jumping in. And this raises an important question, maybe for you listening. Is the sort of easy money phase for new corporate entrants over? Will it get harder for new firms to gain traction, maybe creating an increasingly exclusive club?
Interesting perspective. Okay, let's shift gears slightly. Moving from corporate strategy to the broader environment, what's happening on the regulatory and security fronts globally. It seems like a complex picture, but maybe things are getting clearer.
It is complex, definitely. But yes, we are seeing clarifying frameworks in some places while new security concerns are popping up elsewhere. In the U.S., the SEC greenlit liquid staking. That's actually quite significant. They've exempted key services like Lido for Ethereum and Jito for Solana from being classified under securities laws.
It's big for DeFi.
Huge. It's seen as a major step towards clearer digital asset rules. It signals maybe a more nuanced understanding from regulators, moving away from just, a one-size-fits-all enforcement approach.
Yeah.
This kind of pragmatic stance, it reduces systemic risk across the industry and definitely boosts investor confidence.
And we saw a pretty major reversal in the UK as well, didn't we?
Indeed. The UK's Financial Conduct Authority, the FCA, they're lifting their 4-year ban on retail investors accessing crypto exchange-traded notes, ETNs. That starts October 8th. They cited how the market's evolved, how these products are more mainstream now, better understood. So this move allows individual investors in the UK to buy crypto ETNs that are traded on FCA-approved UK exchanges.
Brings them in line with other centers.
Exactly. Aligns the UK with other global financial hubs. And it could mean UK investors rely less on, perhaps, unregulated offshore exchanges. Though it's worth noting, these ETNs won't be covered by the UK's compensation scheme.
Okay. And South Korea is getting into the stablecoin game, too.
That's right. South Korea has launched a pilot program for its first stablecoin pegged to the won, their currency. It's called KRWIN. This is really to test its technical feasibility, how it might work in the real world. It's part of a bigger push by their government to get a regulatory framework for stablecoins sorted out. They seem driven by concerns that the rise of dollar-pegged stablecoins could potentially weaken the won's position in the future digital economy.
So national digital currency initiatives gaining steam.
Definitely signals growing momentum for state-backed or at least regulated digital currencies, especially in major Asian economies.
But amidst all these clarifying moves, we're also hearing new warnings about security. It seems some countries are getting quite concerned about biometric data collection.
Yes, that's coming out of China. Their Ministry of State Security issued a public warning about national security threats they see from certain crypto projects. Specifically, they're worried about projects that collect citizens' biometric data, things like iris scans, in exchange for digital assets. They cited risks of data leaks, potential misuse, and they highlighted a specific case where some foreign company's fingerprint payment system was compromised. This reflects a growing focus by state actors like China on the national security side of these digital asset projects. And it could signal a potential crackdown on activities by projects like, say, WorldCoin, which often use that kind of biometric verification.
Okay, so a lot to digest there. Regulation clarifying in some areas, new security concerns in others, alongside this massive institutional adoption. What does this all mean for you, the learner, trying to make sense of it all? It really feels like a market at a crucial inflection point, doesn't it?
Stepping back one last time, I think the market truly is in a healthy consolidation phase. That bearish pressure we talked about from the short-term ETF profit-taking, it really appears to be more of a tactical, temporary thing. In contrast, those bullish forces we discussed, the deepening institutional integration, the fundamental de-risking of the asset class as regulations get clearer, that global environment sorting itself out, these feel structural. They feel long-lasting. So the long-term investment thesis for digital assets, you could argue, has actually been significantly reinforced through all this. Bitcoin's key support, remember, remains around that $112,000 level, with resistance up near $116,000. The underlying current still feels strong.
That's a really powerful summary. So as you reflect on this deep dive, here's maybe a final thought for you to ponder. Given that increasing difficulty for individuals to actually own a full Bitcoin and this aggressive move by corporations into not just holding, but earning yield on other digital assets like Ether and Solana, how might the landscape of digital asset ownership and utility evolve over the next few years? Will individual participation maybe shift away from direct ownership towards getting exposure through institutional products? And what are the implications of that for the original decentralized vision of crypto? Something to think about.